It has been a banner year for nearly every corner of the market, and none more so than the energy sector. It is the top performing sector in the S&P, up nearly, get this, 50%, mirroring the rise in oil prices. With just 4 days to go in the year, the energy sector is on pace for its best year on record, going back to its inception in 1989. Let's talk more about what the new year may hold for energy and oil prices. Janine Wei, U.S. oil and gas exploration analyst at Barclays. Janine, great to have you on. Energy was not expected to be the top performing sector when we started this year. Why do you think it's rallied so much, and can it continue?
We think it's rallied a lot for a couple of reasons. Seema, thank you so much for having Barclays on. We do think that there's healthy upside from here with the stocks. It really comes back to the fact that we're transitioning to phase 2 of energy show me story. And in phase 2, that means that we're establishing very attractive cash payout yields to investors. And establishing cash payout yields to investors, that means that investors can start capitalizing future dividends, future special dividends, future buybacks into valuations to cause the stocks go higher. These payouts, they really will lead to solid sponsorship in the sector, which we think is what is lacking right now in the stocks. In terms of how much it can go, if you look on a valuation perspective, our stocks, they're discounting still 18 to 21% disconnect from where the commodity is right now. So we think there's a fair amount of upside from here.
That's interesting. I mean, oil went from $45 to now $76 for WTI crude. You expect prices to go up even more. And what's also striking to me is every part of the energy trade really worked this year. The drillers, the refiners, the producers. Which part of the energy market do you like best going into 2022?
Well, we cover the upstream producers, and again, we think there's pretty good upside from there. It all goes back to the show me story again for energy. Phase 1 is essentially complete, solid free cash flow, and having good cash return frameworks. That's now table stakes for large caps, which is very attractive for investors. We think going forward, the payout yields are going to matter more, and that makes a lot of sense given that we could be in for a bumpy Q1 22 on the macro, and now, given all the free cash flow in the sector for upstream, investors are now being paid very handsomely to sit in these stocks and ride out the volatility.
It looks like your top pick is Hess, is that right?
No, we've got a lot of names that we like overweight. In terms of having payouts, we're overweight on Pioneer, Marathon, as well as Devon.
Got it. And back to some of the other macro headwinds that can always, sort of shift the narrative around energy. OPEC, we saw one production cut. Are we expecting more in 2022?
We'll have to see. Our oil strategist, Amar Singh, he's pretty positive on the oil market in 2022, and that would hinge on OPEC Plus maintaining discipline and showing good disciplined behavior, which we think will continue.
The supply chain issues didn't really stop the oil rally. If anything, it pushed oil even higher, right? Because then it brought up questions around the supply-demand equation. Do you see shortages becoming an issue in 2022? Has the supply chain congestion eased in recent weeks, as many retailers are saying it has?
Well, we haven't really seen the supply chain issues show up that much right now in upstream. What we do think will be a meaningful headwind in 2022 is inflation. And arguably that could be tied to supply chain. But on inflation, we think investors are really holding their breath on that. It's running rampant in every sector you look at in the S&P. Most investors think that inflation in upstream will exceed the 10 to 15% that our companies have been talking about on the latest earnings calls. However, in our opinion, even though inflation concerns may be very real, the sector, the companies, they're all very committed to capital discipline. And because they're committed to that, we don't think that the companies are going to chase growth at the expense of returns. And that should still be a very positive feedback loop for the sector.